All right, so we're going to talk about price elasticity of supply. So this coming from chapter 5 of our OpenStax Introduction to Economics textbook, continuing our discussion on elasticities. So we had the price elasticity of demand, what happens when we move along a demand curve. We had the income elasticity of demand, measuring uh, the sensitivity of quantity demanded to changes in income, whether consumption goes up or down, a normal good versus an inferior good, and by how much consumption goes up when income increases. So that was the distinction between a luxury versus a necessity good. Uh, then we had the cross price elasticity of demand, measuring the kind of what we call the ripple effect, right? How a change in the price of one good affects the demand for another. The last in our series of elasticities is going to switch over to the supply side. So the price elasticity of supply, following the pattern, right, is going to be measuring the sensitivity now of quantity supplied to changes in price. So we spent a little bit of time thinking about, kind of motivating why it's important to know those other measures of elasticity on the demand side from the point of view of a seller. This is going to be a lot easier to motivate, right? It's going to be real important to know your ability to increase production when it's profitable to do so, right? We all know the law of supply, right? When price goes up, that profit motive kicks in and firms are going to want to sell more at that higher revenue per unit. But there are limitations on that ability to increase production at a moment's notice. So this measure of elasticity is going to quantify that sensitivity, if you will. Right. So again, that movement along the supply curve is driven by the profit motive. Right? Price goes up, we want to sell more, take advantage of that high price. So knowing what that elasticity is, again, is going to tell us how successful a firm is going to be at doing that. And just as we saw in all those previous cases, we're going to be calculating and interpreting this measure as a ratio of percentage changes. So the percentage change in quantity supplied due to, relative to, mathematically divided by the percentage change in price that caused it, with the addendum, right, ceteris paribus. So we're assuming nothing else is happening at the same time to affect quantity supplied. So it's the isolated effect of a change in price. And just like we saw in those other cases, we can have kind of a broad distinction between different types of supply curves, those that are elastic and those that are inelastic. And continuing that theme, when we have an elastic supply curve, we have a high degree of sensitivity, right? The change in quantity supplied is going to be relatively large compared to the change in price. So from the seller's point of view, what that's saying is if I can earn a little bit more revenue per unit, I'm going to be able to really take advantage of that to put a lot more of my product onto market. So that change in quantity is going to be larger than the change in price that caused it. And the resulting ratio, that PES, percent change in quantity over price, numerator greater than the denominator, is going to be greater than 1. So thinking about what that means, easy to think about that in terms of, again, this idea of flexibility. So you're producing something that's that has readily available resources. Right? So if it does come to pass that I want to increase my production, I'm not locked into what I currently have, right? I can go get more land, labor, and capital and use it to produce additional units. The other thing that can affect elasticity, as we saw on the demand side, is the time frame, right? So if we're looking at a supply curve over a long period of time, well, we have more time to obtain resources and increase production when price goes up, and we're going to tend to see a more elastic supply over a longer time frame. So, not a great example, but one that comes to mind. Something like the production of cardboard boxes, right? We're not looking at highly skilled labor and natural resources that are scarce. The resources, the physical resources that go into it, the human capital, the labor are pretty readily available, right? So it's not going to be that difficult to ramp up your production when it becomes profitable to do so. So that kind of scenario would be, an example of a more elastic supply. The visual on that is going to be with a relatively, to put it in vague mathematical terms, a flat supply curve, right, which would indicate, right, the slope, the rise over the run, that change in price is going to be relatively small compared to the change in quantity that results. That's going to be the picture of an elastic supply curve. You may recall we had this whole discussion on the demand side about the relationship between slope and elasticity, and technically along a linear demand curve, there's always going to be regions that are elastic and regions that are inelastic. That's not the case here on the supply side. So I'm not going to go through the math. It's actually kind of interesting if you wanted to spend a few minutes working this out, but it can be shown that if the vertical intercept, the y-intercept of your supply curve, hits the y-axis at a positive value, so above the origin, no matter what the slope is at that point, the elasticity is going to be greater than one. It's going to be elastic. So it's easiest to think about it as we're pivoting right around, say, a central point. As that supply curve flattens out, it becomes more elastic. And then anytime we have a positive y-intercept, it's going to be consistent with an elastic supply. So again, a small increase in consumer willingness to pay. Imagine a demand curve shifting to the right is going to induce a relatively large increase in quantity supplied, a highly sensitive production process. Just for example, to throw some numbers at it, if it were the case that the percent change in quantity supplied was 5%, and that was responding to a 2% increase in price, well, the supply elasticity ratio, right, change in quantity over change in price, 5 over 2 would give us a value of 2.5, which is noticeably greater than 1. And then we would put that into a sentence, interpret that saying, for every 1% change in price, we're going to see a 2.5% increase in quantity supply moving along this supply curve. Not all production processes are going to be flexible, are going to have readily available resources. And when that's the case, we're going to see an inelastic supply. So what that means, our supply ratio, I'm sorry, our elasticity of supply ratio is going to be less than 1. We're going to have a small change in quantity in the numerator relative to a larger change in price in the denominator. So that fraction is going to be less than 1. And our supply process would be deemed inelastic in that case. And again, what does that mean? It means you want to produce more, price has gone up, and you want to respond, but your process is relatively inflexible. The necessary resources and technology are going to be scarce, highly specialized, take a long time to acquire, and you're going to be sitting there looking at all this money, right, uh, to be had out there and not able to take advantage of it because you're not able to increase your production. And just like on the elastic side, which said the longer the time frame we have to react, the more elastic supply is going to be. Well, the shorter the time frame, the more inelastic that supply is going to be. So lots of good examples here. Oil production, right, takes years and years to ramp up to dig new wells and et cetera, et cetera. Um, Advanced chips, GPUs, right, being used in AI, highly sought after product, very, very profitable. The price is there, but it takes time for these firms, right, to increase their production because the labor is highly specialized. There's not people, you can't just, put an ad in the paper and get 100 people ready to work the line to produce chips. They've got to be trained. That takes time. And then the natural resources, right, rare earth metals that go into every chip, well, you got to acquire that as well. The capital equipment used in production isn't readily available. It has to be kind of custom produced. So all of that adds up to an inelastic supply scenario. Price goes up, it'll take you a long time to ramp up production to a large value. And what that will look like visually on our supply curve, we're going to be now pivoting that supply curve uh, such that it has a steeper slope. And note what's happened here, right? Our vertical intercept now is below the origin. So that's an indication of steepness. And again, it can be shown that no matter what the slope is, once we see that uh, intercept is below zero, we're going to have an inelastic supply. So again, imagine this is the case for those graphic processing unit chips. A large increase in price will only yield a small increase in production, not by choice, but by the restrictions on the production process. So relatively steep curve, a negative y-intercept, large increase in willingness to pay. Again, imagine a demand curve shifting to the right will only yield a small increase in production. And again, just to imagine putting some numbers to it, if we had the 5% increase in quantity, just as we saw before, but now it's reacting to a 10% increase in price, our elasticity ratio, change in quantity over change in price in percentage terms, 5 over 10 would be 1/2 or 0.5. And again, we notice that's less than 1, so it puts us in that inelastic category. And then our interpretation would be for every 1% increase in price, we would see only a 0.5% increase in quantity supplied. Just like we saw on the demand curve, right, we can see the extreme cases of elasticity on the supply side as well. So thinking about pivoting that supply curve to get flatter and flatter, well, as soon as it's perfectly flat, a horizontal line, we have a perfectly elastic supply. So this would be the case where, at least for some range of production, we have infinite flexibility. We're able to accommodate entirely an increase in demand without raising the price, without driving that price up. And think about what that means, right? That supply curve, the height of the supply curve, is also representing the marginal cost of production. So this would be a case, say, software production or music downloads, where the marginal cost of putting one more unit out there, one more download, is essentially zero, at least for a certain range. So as demand increases, you can accommodate that demand without driving up costs and driving up price. So that would be the ultimate flexibility in production, perfectly elastic supply. Pivot the other way until it becomes a vertical line. Now we have zero flexibility, zero ability to accommodate an increase in demand. And the only thing that's going to happen when we have this perfectly inelastic scenario, when demand increases, is it's just going to raise the price. So think about starting at price level P1, demand increases, leading to a shortage. And as always, that sends the signal to raise price. But as price goes up, nothing is happening to quantity supplied. So all of the accommodation, if you will, is coming on the demand side and putting us at the same quantity, but at a higher price. So this would be the case in, basically any production process at a very, very short time frame, right? If you just have a day to increase production, you're not going to be able to do it. Another kind of easy example of a scenario like this would be, ticket sales for a fixed capacity venue. So Super Bowl tickets, right? There's only so many of them. There's only so many seats available. And once that last ticket is sold, right, we hit our capacity. Well, now as demand increases, all that's going to do is put upward pressure on price. So again, an extreme example, but in a short time frame, not too uncommon to see. So to kind of wrap up our little discussion here, just thinking about, again, motivating why this is useful information to have from different points of view. So from the business, quote unquote, perspective, right? We can think of knowing the price elasticity of supply for your product and competitor's product is going to help with strategic planning, right? So if your supply is highly inelastic, say, for example, in agriculture, right? The price of a crop goes up. Well, that's great, but it's going to take you, right, a year to change your planning, change how you're using your land and plant and harvest a new set of crops. to take advantage of that. So it's going to be fairly inelastic. A case like that, you can't immediately cash in on a sudden price spike. The more elastic, as we saw, say, like a software company, you can scale instantly to take advantage of that, to increase your production. From policymakers' standpoint, this is something that we'll dig into soon enough. Um, but thinking about strategically placing taxes and subsidies on the production of different products, you need to know what the elasticity of supply and demand is for that product to be able to predict how the effect is going to play out. So if you put a tax on the product with a highly inelastic supply, as that price goes up, the rep or the I should say when the revenue earned comes down because of that tax, the change in quantity is going to be relatively small. So if we're doing this to try to discourage the production of a product due to, say, an externality, pollution, for example, it's not going to have much of an effect. It'll decrease the revenue of the firm, but it's not going to change the actual number of units out there being produced. So predicting the impact of policies on specific markets, you need to know the elasticities on both sides, the demand side and the supply side. From the point of view of investors, right, we can think of volatility as being tied to elasticity. So industries with an inelastic supply, for example, oil, like we talked about, or gold, often see big price swings because supply can't adjust quickly when demand shifts. So all of the impact of a demand shift is on price as we go up and down a very steep supply curve, as opposed to quantity. So commodities with more volatile prices tend to have more inelastic supply. So knowing that, right, knowing kind of ranking different commodities that you're thinking about investing in by elasticity will also be a measure of predicted risk and volatility associated with investing in that product. The more elastic, the more stable the prices are going to be. And that's kind of the last uh, item here from a consumer's point of view. Um, like we said, price stability is going to be tied to an elastic supply. So, as noted here, you'll notice products with elastic supply, fidget spinners, cardboard boxes, etc., apps, digital apps, not appetizers, at Chili's, rarely have long-term shortages because there's quantity accommodation, movement along that supply curve. Things like housing with a highly inelastic supply tend to remain out of equilibrium for larger periods of time because quantity is not able to adjust. So for those reasons and more, we need to know our definitions of price elasticity of supply, how to calculate the ratio, how to interpret the ratio, how to visualize elasticity along a supply curve. And if you can do all that, you will be in fine shape. So thank you for your time.